This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on the trader's equation and probability. Perfect trades cannot exist. However, good trades exist and they're common. Traders need to be able to structure trades where they have a mathematical advantage and edge. I'm going to talk about the mathematical basis of trades, and that's the trader's equation. Traders always need an edge when they're structuring a trade. That's a mathematical advantage. That means that if they take enough of a particular type of trade, they will have a profit over time. For example, we have a buy climax and a lower high. It looks like a reversal. Traders might short below the low of that bar. At this point, it's not a high probability trade. Traders might place a stop either above this bar or above the top of the buy climax. The risk is not big relative to the reward. A lot of beginners like low-risk trades. That's their greatest concern. They don't want to lose money. Their account size is small, they worked hard to build their account, and they know if they lose their account, their dream of becoming a professional trader might disappear. In general, beginners like low-risk trades. However, when the risk is small, so is the probability of profit. As long as the risk and profit and reward make sense, the trade is still a very profitable trade. But you need to balance out the risk, reward, and probability. That means you have to structure a trade that has a good balance. Some traders prefer higher probability trades, and that means they wait for strong breakouts. For example, waiting to sell once you have a pair of consecutive big bear trend bars and selling that close or selling this small double top bear flag below that low is a higher probability trade, but the stop is up here. The stop is further away, so the risk is greater. Also, you're entering later in the trade. There's less profit remaining. The risk-reward of entering here is not as good as the risk-reward of entering here. However, the probability that you'll make money is greater here than it is here. That's the trade-off. Some traders prefer small risk. In other words, they want a very good risk-reward equation, and they enter here where they have smaller risk. Other trades prefer to win frequently, and they go for high probability trades. However, that means that the risk-reward ratio is worse. It usually means that the stop is further away. Over the short run, a day or 2 or 3, trading is a zero-sum game. Over the long run, years, it's not. But as a trader, you're trading either for a day, a week, or a month. You're trying to take money from very smart people, and it's difficult to do. However, that challenge is part of the fun. And if you structure your trades properly and manage them properly, you'll have a very good chance of consistently making money. An edge, a mathematical advantage, is usually fleeting and small. Even the best traders do not have a very high probability of making a big profit all of the time. Any advantage that they have is small. However, if they're consistent and they're capable of consistently trading properly, that small mathematical advantage can result in very big profits over time. High-frequency trading firms, HFT, use algorithms for only days to weeks at a time before switching to a different type of algorithm. Here we have a very tight trading range. Traders look to buy low, sell high, and scalp. Everybody wants a perfect trade. However, a perfect trade cannot exist because before long, everyone would discover it and no one would be willing to take the other side of the trade, and the trade would stop working. Here's a trading range. High-frequency trading firms would detect that the market's starting to enter a trading range, and they would start looking to buy low and scalp, and sell high and scalp, because that is what is most profitable when the market is behaving like this. On the other hand, trading ranges eventually break out, as this one did here. We have a strong bear breakout and a strong follow-through bar. The market is probably going to fall for some kind of a measured move, and traders selling here have a high probability of making money. The traders who bought low, for example, traders who had limit orders to buy here, now are going to lose money. The algorithms and the style of trading that was profitable when the market was doing that are no longer profitable once the market begins to trend. In this case, the bears will not be able to sell high because the market is not high, it's only going down. And bulls buying low are going to have a hard time making money if the channel down is tight. Instead of buying low, selling high, and scalping, traders should only sell, and they should swing trade. Bear breakout, consecutive bear bars, both closing below the low of the trading range. High probability the market will fall for some kind of a measured move, maybe based on the height of the range, maybe based upon the height of the breakout, the open of this bar to the close of that bar, measured move down. And then there will be other measured moves as the channel unfolds. This is a spike and then a pullback, and that pullback is the start of a channel. The market became a spike and channel bear trend. And it's very tight, and when it's tight, it's impossible for the bulls to make money, and therefore traders should not buy. And when the channel is tight, it's impossible for the bulls to make money, and therefore traders should not buy. Traders looking to sell high cannot sell high because the market is only pulling back for a bar or two and never gets high. Traders have to sell for other reasons like below bars, sell bull closes, or sell breakouts to new lows. Instead of buying low, selling high, you cannot buy at all. Instead of selling high, you have to sell low. Breakouts of bear flags, attempts to reverse up. In any case, you'll be selling near the bottom of the market, betting that it will go lower, and that is the correct strategy. A perfect trade has a high probability of a big reward with very little risk. That cannot exist because there would be nobody to take the other side of the trade. If you have a very high probability of a big reward with very little risk, no institution is going to take the other side, because if your trade is perfectly good for you, it's perfectly bad for him. He has a low probability of making only a small reward with a very big risk. You cannot get all three variables, probability, reward, and risk, on your side. You can usually get one, often you can get two, but you can never get all three. Usually the trade-off is between high probability versus risk reward. Some traders want high risk reward that has a lower probability of making money. Other traders want high probability, but that usually comes with a worse risk reward profile, usually bigger risk, a stop further away. Again, perfect trades cannot exist because someone has to take the other side of the trade, and no firm is going to take a trade with very little probability of making money, and they only stand to gain a small reward, and the risk is big. Any trade that approaches perfection will be traded very quickly, and the opportunity will not last long. Trading range setups are never all that clear, so the probability is not all that high, but the risk is small. Strong bear breakout, the probability is high that the market is going down further. However, the risk is usually bigger. The stop is further away. Breakout, high probability, worse risk reward. Trading range, low probability, but better risk reward. Bear channel, it's a breakout on a higher time frame chart. The probability is still good, but it's not quite as good as selling during the breakout. Again, the stop when you're in a trend is usually further away than it would be within a trading range. So the risk is greater when you're trading in a trend, but the probability of making money is greater as well. The market is in a cycle. It's in a trading range, and then it breaks out and enters a trend. The trend eventually becomes a trading range again, and then it decides whether to reverse into an opposite trend or to resume the trend, break below the trading range. Traders should not expect any strategy to last for too long because the market will constantly alternate between a trading range and a trend. The trend can be up or down, and when you have a trading range, the breakout can be down or up. Once too many computers begin to detect what the market is doing, the market usually does something else. For example, if it's in a trading range, it eventually breaks out, and if everybody starts trend trading, eventually no one will take the other side of the trade, and the market starts to go sideways. Breakouts are brief. On any chart, on any time frame, only about 5 to 10% of the bars on the chart are in strong breakouts. For example, here, strong breakout, another strong breakout here. Lots of breakouts here, but they all failed. But in general, 5 to 10% of the bars on a chart are in a successful breakout. So the opportunity to make money during a breakout is brief. And once you're in a channel, it eventually will start flattening out and evolve into a trading range, waiting for the next breakout, up or down. Entering a trade during a strong breakout is as close as you get to a perfect trade. However, the opportunity does not last long. Traders who are selling as this is falling, if they're sensing that the market is falling fast and likely to break out successfully, they have a brief opportunity to sell here or here where the stop is not very far away, the risk is not great, and the probability of profit is high, and the potential for reward is big, but that is only a very brief opportunity. Once everyone sees the opportunity, you get some profit taking, and the market then gets a pullback, and the strong breakout gets replaced by some uncertainty and eventually a channel. Institutions detect the quick momentum down, and they're selling quickly, and that is creating the breakout. As I said, it's a brief opportunity for a trade that is as close as you can get to perfection. It does not last long. As the breakout grows, the risk increases, and all of a sudden it becomes less perfect. There's also a reasonable chance that a breakout will fail. In general, if you have a strong breakout like this, there's a 40% chance that it will fail and reverse back up. 60% chance it'll go down at least for a measured move. That's when the breakout is strong like this. We have a breakout, another breakout bar, both closing below the trading range, and then no bull bar for the follow through. We have dojis here, so weak reversal attempt. This is a 60% trade, 60% chance it's going to fall for at least a measured move. Anytime a trade approaches perfection, everyone sees it and everyone starts trading in that direction. Early in this breakout, everyone is selling, knowing that probability is high of making money and the stop is not far away. And the bar is big because everyone sees this as potentially a perfect trade. There is a risk factor, and part of it is time. The stop might not be far away, but you have the risk of making mistakes in your decision, assessing whether or not the breakout will be successful. And a lot of traders are uncomfortable making those quick decisions and placing those trades. And therefore they'll wait to see a couple strong closes and then sell a close down here. Knowing that it's less perfect, stop is now further away, but you still have a high probability of a profit. When a trade is close to perfect, you get a huge trend bar because everybody is quickly taking the trade. And as the bar becomes big, the stop gets further away, and that increases the risk. And if you enter down here, not only is the stop further away, but there's less reward remaining in the trade. So the risk-reward ratio is becoming worse. No matter how good you are, your edge, your mathematical advantage is always going to be small. The key to making money consistently is learning how to become consistently good. No one's going to give you money. Trading is always going to be hard, but that's part of the fun, the challenge. Traders always wonder if they have to be perfect. They do not have to be perfect. All they have to do is trade well consistently. Learn how to structure trades where there's a mathematical advantage, use appropriate stops and exits, and manage the trades correctly. Whenever a trader takes a trade, he's always thinking, am I going to make money if I take this trade? At least subconsciously, traders are only going to take a trade if they believe the probability of making money times the size of the reward is significantly greater than the chance of losing money times the risk. And that is the trader's equation. I'm going to talk about the trader's equation now. Traders only take a trade if they believe that the probability of making money times the potential reward is significantly greater than the probability of losing money times the risk. You know what the reward is. That's your profit target. That's the money you're hoping to make. And you know the risk as well. You know where your stop is, so you know how much money you're risking. What you never know is the probability. However, it's safe to assume that the probability is always going to be between 40 and 60%. It's closer to 60% during strong breakouts, and then in trading ranges and weaker trends, the probability is less. In a trading range, for example, it sometimes is only 40% unless you use a wide stop and scale in. This is the trader's equation. If it's positive, then it makes mathematical sense to take the trade. You can even lose 60% of the time and still make money if the risk-reward ratio is good enough to offset that low probability. Here's the E-mini, a 5-minute chart, and I want to talk about 10 theoretical trades. Assume you take 10 trades and your profit target is 4 points and you use a stop that's 2 points away. So your reward is twice as big as your risk. 4 is twice as big as 2. And let's say you only win 40% of the trades. So of the 10 trades, you only win 4 times and 6 times you do not win. Those 6 times might be small losses, they might be small wins. Some of them will hit the stop, but none will be more than 2 points because you have a 2-point stop. For example, let's say you sell below this bear inside bar and you sell here. You place a limit order to take profits at 4 points and you get filled here. You have a stop 2 points above. You're risking 2 points and you made your 4 points at the bottom of this red box. Let's say you see the reversal. You think of it as a wedge and then a pretty good reversal. You think it's going higher and you buy in a stop above this pullback bar here and you get filled there. Again, you place a stop 2 points down. You place a limit order to take profits 4 points up and you get filled right there. This is another profitable trade. You made 4 points, you risked 2 points, your stop was not hit. And let's say you sold here, took profits here. Sold here, take 4 points profit here, here, here. On the way up, you bought above this inside bar, took profits here. You bought above here, took profits here. Many profitable 4-point trades. On the other hand, if you bought here, hoping for a reversal up, it did not quite make 4 points. You sold on the reversal down, thinking it's a minor reversal and the bear trend would probably try to resume. You made less than 4 points. And let's say you see this as a potential double bottom and you bought above this bull bar. You put your stop either below the low of the signal bar or maybe the low of the bear trend, or you just rely on your 2-point stop. And let's say you get stopped out here for a 2-point loss. And then here as well, you got a high 2 bull flag, you buy, and then you get a bear reversal bar. You either exit below that bar or you rely on your 2-point stop. You lost 2 points here, you lost 2 points here, you lost 2 points there. We have a strong trend down, strong trend up. It's easier to make money. Reasonable swing trades should win 40% or more of the time. And because of the strong trend, we have 10 trades, 7 of them were winners and only 3 of them were losers. On the other hand, let's say instead of 70% win, let's say only 4 were winners. So you had 4 trades, each making 4 points. Your total profit on the winning trades is 16 points. And let's say you had 6 losers that hit your stop. You would lose 12 points. Your net profit would be 16 minus 12, 4 points. Greater than 0, you have a positive trader's equation. You have 40% winners times 4 points. That is greater than 60% losers times 2 points. That's a positive trader's equation. So the strategy that you are employing here makes sense mathematically. And over time, you have a very good chance of consistently making money. The math is actually better than what I just described because if you're swing trading, you're not going to be taking profits at 4 points. You'll hold on to the trade until it no longer makes sense to hold on to it. For example, until there's an opposite signal or until the end of the day. Your winners, then, many of them, will be much more than 4 points. Also, 60% of the time, you're not making 4 points. That does not mean you're losing 2 points on each of those 6 losing trades out of 10. Some of the trades will be 2-point losers, some will be 1-point losers, some will be 1-point winners, some will be 2-point winners. Those 60% of trades when you're not making your profit target balance each other out. Some are small winners, some are small losers. You're not going to have 60% of the time hitting your 2-point stop. I want to give an example using the euro versus the dollar forex market. Here's a 5-minute chart, and I want to talk about 5 possible trades. Assume you're using a profit target of 40 pips and a protective stop of 20 pips. And let's say you only win 40% of the time. 40% of 5 trades, that means you're winning 2 trades out of the 5. We have a strong bear trend, and let's say you sold here and you placed a limit order to buy back with a 40 pip profit, and you had to stop 20 pips up. Here, the market quickly went down to your target, and you'd exit with a 40 pip profit at the bottom of this red box. We have a very strong reversal up after 3 pushes down, 1, 2, 3. Probably we'll try to get a second leg up. Let's say you place a buy stop order above the high of this bull bar, and you placed a stop 20 pips down. The market turned back down, but it did not quite reach a 20 pip stop. It resumed up for a second leg, and you would have been filled with your limit order 40 pips above your entry. Another profitable trade. You buy here, stop just down here. This did not reach it, and you exit up here with 40 pips profit. The bears made 40 pips here. The bulls made 20 pips here. And again, the bulls made 20 pips here. A high 2 bull flag, 2 legs down, a test of the top of this range. And it went up 40 pips before the stop was hit. On the other hand, let's say you sold below this reversal bar. The bulls tried to create a bull trend and the market reversed back down. However, the market reversed up from a new low. You had a profit target down here to take profits at 40 pips. You had a stop up there 20 pips above. You sold here. It did not hit your stop. However, this reversal is a good enough reason to exit. You'd exit above the high of this bull bar, which is maybe a pip or two profit from this short. And then again here, let's say you bought above this bar, a wedge, 1, 2, 3, decent bull bar, and you put your stop below the low of the day, below here. You were quickly stopped out. It's less than a 20 pip loss, but you still were stopped out. Reasonable swing trades should win 40 or more % of the time. Here we have a strong trend down and a strong trend up. You probably have better than a 40% chance of winning with your swing trades. We have 3 trades that reached a swing target of twice as big as the risk. They made 40 pips while risking 20 pips, and you had 2 trades where you did not make your 40 pips. Here you might have made a pip or 2, and here you may have lost about 15 pips or so. 2 losing trades, 3 winning trades. Let's assume instead that you only had 2 winning trades. You had 2 winners times 40 pips, would be 80 pips total profit. You had 3 losers. Let's say your losers all hit the protective stop and you lost 20 pips on each. 3 losers times 20 pips, your total loss is 60 pips. Your net profit is 80 minus 60, 20 pips. That means that the probability of winning, here it turned out to be 40%, times the reward, is greater than the probability of losing, here 60%, times the risk. That is a positive trader's equation, and that means this type of strategy is mathematically profitable. You have an edge. And if you employ this strategy over time, you have a good chance of consistently being profitable. The math is actually better than that because some of the winners are more than 40 pips. If you're swing trading, you won't necessarily take profits here. You may swing part of it until the trend is no longer in effect, until the end of the session, until there's a clear opposite signal. So some of the winners would actually be more than 40 pips. 60% of the time, you do not make a swing profit. You do not make 40 pips. But that does not mean your stop gets hit during those 60% of the trades. Some of them are small losers, some of them are 20 pip losses, your stop gets hit, and some of them are small winners. And the 60% of the time when you do not make your 40 pip profit, those times tend to balance each other out. Some small winners, some small losers. I began by talking about perfect trades and a mathematical advantage. Perfect trades cannot exist. However, if you structure your trades properly, you can have a mathematical advantage, an edge. And then I moved on to talk about the trader's equation. If the probability of making money times your potential reward is significantly greater than the probability of losing money times your risk, you have a positive trader's equation, and the trade that you just structured has a mathematical advantage. You have a good chance of making money. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on the trader's equation and probability. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on the trader's equation and probability. Traders often hear about risk-reward ratios, 2 variables when you take a trade, risk and reward. There's an equally important variable that you never hear about, and that's probability. You have to consider all 3 variables whenever you're taking a trade: probability, risk, and reward. If you want, you can think of them as simply two variables, probability and then the risk-reward ratio. If a trader sees this breakout with this big tail and then a second attempt to go up and another reversal down here, he might sell below the low of this bar and put a stop either above the high of this bar or up here. The result was a big bear trend. Whether he had to stop here or here, the reward was small compared to the risk. He ended up taking a trade that had a very good risk-reward ratio. However, selling right here, the probability that you're going to get a swing down is small. More likely, you're going to go sideways. Low probability, very big risk-reward ratio. If a trader prefers higher probability, he'll wait for the bear breakout and a follow-through bar, this bar closing below the low of the past 30 bars. The probability is high that the market's going to fall for at least a measured move from the open of this bear breakout to the close of the bear breakout, which is down here. 60% chance or more that we're falling down here. Yet if you sell here, you're getting a high probability trade, but your stop is still here or here. So the risk is much greater than for a trader who sold here. This trader had great risk reward and lower probability. This trader has worse risk. His stop is further away, but a higher probability of making money. You could also sell below this double top bear flag, a low 1, low 2, double top this high and this high. That is also a high probability trade for making money. But again, the stop is up here, and that's the trade-off. You either get a high probability of making money, it's always accompanied with bad risk reward, or you have a trade with excellent risk reward that's always accompanied by bad probability. For every trade, there's always one institution buying and another institution selling, and there has to be a reason for both of them to take the trade. In general, it's a trade-off. One trader gets better probability and worse risk reward. The other institution gets worse probability but better risk reward. Both are acceptable if you manage the trade correctly. Should you buy or sell? You choose the variable that's more important to you. Some traders always try to take high probability trades because they like to win a lot. However, that always means smaller risk reward. In general, the risk is greater, the reward is less. Other traders really focus on big reward. They like to get very big winners. However, when they do that, it's always accompanied by lower probability. When traders start out, they work really hard to save enough money to trade. The one variable that they consider far beyond any other is risk. They don't want to lose money. They're afraid that if they lose money, they'll lose their account and they'll lose their dream. It'll be the death of their dream. So it's the equivalent of dying. And when traders begin trading, they tend to focus only on risk. And they often totally ignore probability, which is unfortunate because you need to pay attention to all three variables if you're going to trade profitably. Beginners are always looking for the lowest risk trades, and they lose money. And it's because they don't understand that a low risk trade means low probability. That means you're going to lose most of the time. And then if you add to it poor management because of inexperience, your losses are going to be bigger and you're going to lose even a higher percentage of the time. It doesn't matter whether you take a trade with a great risk reward and lower probability or a trade with a higher probability and worse risk reward if you manage the trade properly. Both are reasonable ways to trade. Both have positive traders' equations. Some traders don't worry too much about picking exact tops and bottoms. A lot of them will wait for a pullback or a breakout because then the probability of making money is higher. They'll sell the breakout or they'll sell the bear flag, the pullback from that breakout. These traders are comfortable having a stop far away, either here or here, because they know the probability is high that they'll make money. That bigger risk is the price they pay to get the high probability of a profit. Experienced traders will sometimes take lower risk, lower probability trades. Other times they'll take higher probability, bigger risk trades, whichever one they feel like gives them the better edge. For example, if a trader has to leave soon and they cannot stay to watch the trade all day, They need a high probability trade. They need a quick profit, a small profit. A small profit means a small reward. It's a scalp. That means if they're going to take the trade, they're expecting to win a high percentage of the time. The best way to improve a risk-reward ratio is to swing trade. Go for a very big reward. For example, sell and you stay short until the market either reverses or until the end of the session. Let's say a trader sells below this low and uses a very tight stop just above the high of that bar. So they get short right here below that bar. If he's a scalper, he might get out with 1 times his initial risk. His initial risk is above the high of the sell signal bar. He entered here, and this is 1 times his risk. A swing trader, on the other hand, will stay with the trade until the trade is no longer valid. Here, 3 pushes down, 1, 2, 3, a parabolic wedge. We have a bull bar closing on its high. Maybe we'll get a minor reversal. This is a reasonable place to exit, but look at the size of the reward, entering here and exiting here, risking to here or here. So excellent risk-reward ratio, but low probability, 40% chance he's going to get the swing down, 60% chance he's not going to get the swing down. Either the market will go up and hit a stop, or it'll simply go sideways. The huge reward relative to risk more than offsets the low probability of a very big profit. It's reasonable to sell there. There's another way to improve the trader's equation, and that's by scaling in, adding to a position, even if it's a losing position. Beginners should not do that. Scaling into a trade increases the probability of making money. But you pay for that with a worse risk-reward ratio. You're increasing your risk, and you're usually reducing your reward as well. For example, we have a bear trend, but we have 3 pushes down, 1, 2, 3. It's a parabolic wedge, consecutive sell climaxes, and there's a bull bar, consecutive bull bars. This is not a high probability sell. However, the reversal up is probably only going to be minor and will probably test back down. When you have a very tight bear channel, the first reversal up is minor, and you're usually going to test back down. The bears sell here, hoping it'll continue down, but confident that the first reversal up will not go far. They can sell more and then get out around their original entry price, break even on their first short, and then with a profit on their second short. Sell more maybe below here, a low 2 or a low 3, low 1, low 2, maybe this is a low 2 and this is a low 3. It's still below the top of the sell climax, it's still below the top of the bear leg. Chances are the market's going to test down to this area. Maybe a stop at the top of that most recent bear leg. He gets out when the market comes down to his original entry price at the low of that bar. He sold just a little bit below that bar. He might get out at the low of that bar and take a tiny loss, or he'll get out just below the low of that bar and get out break even on his first entry, and he gets out with a profit on his second entry. He increased the probability of making money by adding to his position, but he's also increasing his risk. Instead of risking from here to here, he's additionally now risking from here to there as well. So he increased his risk to get the higher probability of making money. Again, only experienced traders should do this kind of a thing. We have a bear trend, a bull breakout, and a higher low, and now we have a double bottom. If you want, you can call it a double bottom, higher low, major trend reversal. You can call it a double bottom bull flag. So bull breakout, a pullback, and then now a double bottom in possibly a bull trend. In any case, we have a bull buy signal bar. Traders will buy above that buy signal bar, and some of them will put a stop just below the double bottom. Very small risk, and that immediately tells you the probability is low. If you take this buy, you're probably going to lose money. It's probably going to fall below the low of that bar. Whenever the risk is small, chances are you're going to lose. Stop just below the double bottom. You're buying in the middle of a tight trading range. Most attempts to break out of a tight trading range fail. Attempts to the downside or attempts to the upside. A trader, on the other hand, might prefer a high probability trade. And here we have a very big bull breakout bar and a second consecutive big bull breakout bar. There's a 60% chance after a strong breakout like this that the market's going to rally for at least a measured move up based upon the open of the breakout to the close of the last bar of the breakout. 60% chance we're going up here. High probability, but the stop is still down here. This trader put his stop here. The trader who bought that close, his stop is here as well. He has a much higher probability of making money, but he also has a much greater risk than the trader who took the initial buy. A triangle, 3 pushes down, 1, 2, 3, 4, and a bull bar. It's still a high probability that the traders will make money if they take the buy above that bull bar. The probability here is not as high as the probability here, slightly lower probability, but still close to 60% that you'll make a profit buying above that bull bar. Buying the breakout, very high probability. Buying the pullback, slightly higher probability. Buying the pullback here, slightly lower probability. Buying here, again, lower probability the higher up you go. We have a bull trend and a bear breakout and a tight trading range. In the tight trading range, we have a double top, lower high, and a bear bar closing on its low. This is a reasonable short. You sell below that bear bar for a double top, lower high, major trend reversal. Stop above that high. Very small risk, and that tells you immediately you're probably going to lose money. 60% of the time, you're going to lose money. 40% of the time, you're going to get a swing. But the swing is so big that it more than offsets the loss. It's reasonable to take that low probability short. Other traders prefer high probability trades. They'll wait for the bear breakout. We have consecutive big bear bars closing below the low of the past 50 bars. High probability that we're going to fall for at least a measured move down. From the open of the bear breakout to the close of this bar, we're going to fall for a measured move down 60% of the time. We're getting a pullback, so increased uncertainty, but it's still a fairly high probability short, either below this bar or that bar. Again, whether you take the short here or here, the stop is still here. So the risk is greater for these high probability shorts compared to this short, but the probability of making money is greater as well. I've met many traders over the years who win 90% of the time. Without asking them, I automatically know that they are scalping. If you're winning 90% of the time, you have to have a bad risk-reward ratio, and that usually means a very small profit. In other words, you're scalping. You cannot get a great variable, 90% probability, without giving something up, usually risk-reward. And that means you're always giving up risk-reward. Usually it means you're taking a small risk and a small profit. I have a high probability of winning, you have a good risk-reward. That means you lose a little and I make a little, but I have a high probability of success. These are all examples of scalps. You buy here, you scalp out. You've got a small bull flag, you buy above the bull bar, you bet against the reversal down, you buy that low, you buy the reversal up. These are all high probability trades if you're taking small profits. Therefore, they're all scalps. Selling here, 3 pushes up, 1, 2, 3, small wedge, bear bar, probably going to turn into a trading range, high probability, small risk. And then these are all scalps. Sell the close, sell the close, sell the low 1, sell the low 2, sell the breakout, sell the double top bear flag, sell the breakout below here, sell the close, sell the low 1 short, all the way down. Lots of scalps. High probability of success if you're taking a small reward. In other words, if you're scalping. Whenever you take any trade, you automatically know the risk and reward. For example, if you're buying, you should automatically, as soon as you enter, put in both a stop to sell if the market goes against you and another order to take profits at a reasonable target. That distance to the profit-taking order is your reward, and the distance to your stop is the risk. You always know the risk and reward with every trade. However, you don't always know probability. In fact, you never know probability. The risk is the number of ticks or pips to your protective stop. The reward is the number of ticks or pips to your profit-taking limited order. The probability is very, very important, but it's never clear, and most traders ignore it, which is too bad because you need to pay attention to it if you want to structure profitable trades. A reversal down, a pair of strong bear bars closing on their lows, you sell the close, a high probability short. Your stop is either above this sell climax or above the top of the bear leg, so you know how much you're risking. With a high probability trade, you know the probability is you'll make at least a reward equal to your risk. You sell that close, stop here or here, and measured move down is here, and the reward is here. A reasonable place to take at least partial profits. A high probability trade, the reward is only equal to risk, so your risk-reward ratio is 1. That's a low risk-reward ratio, but it's mathematically okay because the probability of making money is high. Strong bull breakout, I always look to the left. I want to make sure that the market is above prior highs, that it might be a bull trend. And if I get a strong reversal down, I look to the left as well. Big buy climax, it could fall below that low and still be in a bull trend. If it falls below the bottom of the bull trend, then it's no longer in a bull trend. It's then either in a trading range or bear trend. Whenever you have a strong breakout like this, high probability that you're making money. But you do not yet know if it's a bull leg in a trading range or a bull leg in a bull trend. Not great follow through, might get a deep pullback, but as long as the pullback stays above the bottom of the bull trend, it's still possibly a bull trend. With this big of a reversal, big up, big down, it generates big confusion. Probably the market's now in a trading range. However, as long as it stays above this low, it's not in a bear trend. It's either in a trading range or a bull trend. Strong reversal down and strong follow through. At this instant, the market's always in short. However, it's still above this low. It could simply be a deep pullback in a bull trend or a bear leg in a trading range. Some bears will sell that close. In general, I do not, because it's still around the low of the buy climax and it's still above this low. So that is not a high probability sell, even though you have consecutive bear bars. Look to the left. We're still possibly in a trading range or possibly in a broad bull channel with higher lows and maybe even higher highs. It's always in short, but unless you get strongly below the bottom of this buy climax, it might be simply a bear trap, trapping traders into selling low in a bull channel or a trading range. You cannot tell in this chart, but this low actually fell a tiny bit below the bottom of this buy climax. And that's common. If you have a buy climax and a reversal down, usually the market tries to fall at least a little bit below the bottom of the buy climax. And then it decides whether to form a double bottom with that buy climax and resume up, or break below it and fall for a measured move based upon the height of that buy climax. For the bulls, it's still a bull trend, and it's a double bottom with a buy climax low. It's also a higher low. It's above this low, and it's above that low. Yet, whenever I see a reversal down this far in a bull trend, chances are it's not going to be a strong bull trend. More likely, it's going to be big up, big down, big confusion, and confusion usually means trading range. Bulls will buy the reversal up. You buy low, sell high, and you take quick profits. It's reasonable to buy this low. It's a double bottom with that low, and it's still above the bottom of the bull trend, so it's still a higher low in a possible bull channel. More likely, you're buying low in what will become a trading range. Bull trend and a pullback. As long as the pullback stays above a 50% retracement of the buy climax, the probability favors higher prices. But the risk is greater because your stop is down here or down here. If the market falls below the midpoint, the probability for the bulls is less, but so is the risk because you're closer to the stop. So buying down here, you have less probability of a bull trend, but you also have less risk. Buying up here, the probability is good, better than 50-50, that you'll make money, but the risk is far away, and the reward might not be all that great as well. We have a weak rally, we're probably not going to go much higher. Buying up here, stop down here, not much reward, bad risk-reward ratio, but high probability. So traders buying up here, good probability, but bad risk-reward. Once it dips a little bit below the midpoint, probability drops to about 50% that the market is still in a bull trend. But the risk is less, so if you buy here, you're closer to the stop here or here. You're getting better risk reward, but lower probability. If you're buying in the bottom third, the probability is less that the market's still in a bull trend. Maybe it's only a 40% chance that we're going up to a new high, but the risk is less as well because the stop is here. Whether you buy up here, here, or here, the stop is still here. As the market falls, you're getting closer to the stop. If you're entering down here, if you're buying down here, you have less risk, but after this much of a reversal down, retracing all of the bull trend, you have less probability of the market making a new high. This is the most important price for the bears. It's the bottom of the bull trend. The bears want to get below this low, because if it gets below this low, the market's no longer in a bull trend. It's then either in a trading range or a bear trend. As long as it stays above this low, it's either in a bull trend or a trading range. When you're getting a sell-off like this down to the bottom of the buy climax, you just don't know if it's simply a test of the bottom of the buy climax. As I said, when you get a reversal down after a buy climax, the market usually gets at least a little bit below the bottom of the buy climax. And then you don't know if there are a lot of dollars buying down here, looking for a trend resumption up. Is the market going to form a higher low and be in a broad bull channel? Or is this an actual reversal that will break below the bottom of the bull trend and become a bear trend? Strong reversal up, 5 consecutive bull bars, 8 bars without a bear body. We're back to always in long. That makes a bear trend unlikely. Now we're probably either in a bull trend or a trading range. Anytime I see a strong breakout, I always look to the left. Is the breakout above all of the bars or just above some of the bars? If it's still below this high, this rally could simply be a second leg up in a broad bear channel. First leg pullback, second leg, or a second leg up in a trading range. Even though the market is always in long, maybe by the close of this bar, that does not mean bull trend. It could simply be a bull leg in a bear channel or a bull leg in a trading range. Breakout, follow through. You can call it a head and shoulders bottom, left shoulder head, right shoulder. Bear trend, higher low, major trend reversal. A breakout and follow through above the neckline. We're always in long. We might go up for a measured move. It might, in fact, be the start of a bull trend. But unless it gets above the top of the most recent lower high, it's still in a bear trend. And this could be simply a bull leg within a broad bear channel or a bull leg in a trading range. Traders will buy the close, confident that the probability is high that we're going at least enough up to make a profit. However, unless we get above this high, this rally is simply a double top lower high, or you can call it simply a lower high and possibly a broad bear channel, and traders will look to sell the reversal down. 2 legs up, 1 pullback 2. This could be a second leg trap, trapping traders into thinking it's a bull trend, but if you look to the left, we have not gone above the most recent major lower high, and therefore this could simply be a trap, tricking traders into buying too high in either a bear channel or in a trading range. You can sell the reversal down there, or higher probability, sell this reversal down here, double top bear flag. Strong bull swing, but still possibly a pullback from this strong leg down. Unless we get above that high, a major lower high, no matter how strong this rally is, it still could be simply a pullback from this sell-off. Here's a 50% pullback. As long as the market stays below the 50% pullback, then the probability is at least 50% chance that we're going lower. Below the 50% pullback, the probability favors the bears. The bears selling here have greater risk. They have higher probability. That's always accompanied with greater risk. The bulls need to break above this lower high. Otherwise, we could still be in a bear trend. Again, if it gets above the lower high, it's no longer a bear trend because a bear trend needs lower highs. Down here, the risk is great for the bears. Their stop is way up here, and the probability is high. If you're selling down here, the reward might simply be a measured move down based upon the height of this trading range. We have a double top bear flag, and the risk is greater than that. The distance to this high, if you're selling down here, is greater than a measured move down. So the reward is less than the risk. So it's a bad risk-reward ratio, but a high probability of making money for the bears if they're selling down here and stop up here. If you start selling above the 50% pullback, the risk is getting less because the stop is getting closer, and the probability is getting less as well, the probability for the bears. And if you're selling in the top third of the bear leg, there's a greater chance that we're going to break above the protective stop, a greater chance that this is a trading range instead of a bear trend. It's 60% chance of the bulls getting above that high, and only a 40% chance of the bears getting to a new low. But the risk for the bears is less because they're very close to the stop, and the reward is greater. It's very far away. Bears selling up here have a much better risk-reward ratio, but a much smaller probability of making money. Down here, bears have worse risk-reward, but higher probability. In the bottom half of the bear trend, the probability favors the bears. 60% chance we're going to a new low. And the probability gets less the higher up the market goes, and the risk-reward ratio gets better for the bears. The risk is less and the reward is greater. In the top third, the risk-reward clearly favors the bears. The chance of a new low is less, but the reward is very big relative to the risk. When you have a strong rally like this, but it's below the top of the bear trend, you don't know how many dollars waiting to sell. How many dollars view this as simply a buy vacuum test of resistance? Is this simply a second leg trap, leg one, pullback, leg two, with a lot of bears looking to sell in the upper third? You don't know until you see the reversal down. The probability favors the bulls, but the risk-reward is better for the bears. There are always bears willing to sell. Once you see the reversal down, the probability is getting better for the bears, but if you sell down here, the risk is greater. In this video, I talked about risk, reward, and probability, and I tried to emphasize the importance of probability. A trader cannot simply think about a risk-reward ratio. A great risk-reward ratio is meaningless if the probability of making money is very small. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on the trader's equation and probability. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on the trader's equation and probability. I would like to begin by talking a little bit about the Z-score, which is a mathematical way to measure how profitable a strategy is. And then I want to talk a little bit about probability of the 3 variables that a trader needs to understand when structuring a trade: risk, reward, and probability. Probability is the most important. A Z-score, it's a measure of how good your system is. It's used by quantitative analysts, quants, when they design systems. As a trader, you do not need to know anything about your Z-score, but if you want some better mathematical understanding of how good your method of trading is, the Z-score is one measure that you can use. It's basically the number of standard deviations from a mean. This is the formula, and most of you are not going to be interested in the mathematics of it. N, the total number of trades in the series that you're examining. R, the total number of winning or losing streaks in the series. For example, if you have 2 consecutive winners, that's a winning streak. If you have 7 consecutive losers, that's a losing streak. It doesn't matter how many are in the streak, it's just the number of streaks. And then W, the total number of winning trades, and L, the total number of losing trades. A Z-score measures just how reliable your system is. Can you trust your system going forward. If you have a high Z-score, then you have a much better chance of making money going forward. If you have a low Z-score, you have a much higher risk of losing your money and losing your account. I want to show you this chart, and I want to show you a good way to trade it and a bad way to trade it. For example, let's say you begin by scalping for a reward that is 1 times your risk on second entry reversals. For example, you buy a high 2 bull flag or you sell a low 2 bear flag. Here are some sample entries. Here's the first entry, there's the second entry, so you sell on the second entry. Here's the first entry, here's the second entry, so you buy on the second entry. Again, first, second, a high 2 bull flag, high 1, high 2, a second entry buy, a pullback, high 1, high 2. This is the high 2 here, so you get long there. And then again, high 1, high 2. On the way down, we have a double top, second entry short, a low 2 bear flag, second entry, a low 1 on this bar, a low 2 on that bar, all the way down. Here we have a high 1, high 2 for the reversal up. Now this system has a very high Z-score because it has a high winning percentage. 11 of the 12 trades on this chart are winners, and all the winners are about the same size. Both of those things indicate that you have a very consistent way of trading, and therefore a much better chance of making a profit going forward. The past results are a good predictor of what you'll expect to see in the future. In other words, what you're doing is good. You can miss some trades, but you're confident that you still can make money. Every now and then you'll hear traders talk about a blown account or ruin, risk of ruin. How much risk do you have of blowing your account? A blown account simply means that your account no longer has enough equity to meet margin requirements. Your broker will not let you trade unless you put more money in your account. It can mean that you lost all the money in your account, and it can mean that you lost so much money that you lost more money than is in the account, and you have to send your broker even more money. However, the minimum that you need for your account to be ruined or blown is for the equity to have fallen so low that your broker will no longer let you trade unless you put more money in your account. When you have a high Z-score, the risk of blowing up your account is small, and therefore you can risk more per trade. A best Z-score would be about 5, which is extremely rare, but outstanding scalpers can get a score that high. A really good Z-score is 2 to 3. In general, if you have a very good system, a very good Z-score, you can risk about 2% of your account on every trade that you take. The lower your Z-score, the smaller percentage of your account you should risk on a trade. Here's another system using the same chart. Instead of buying second entry reversals or high 2 bull flags and selling low 2 bear flags, let's say instead you bought at the high of the prior 10 bars and you reversed to short below the low of the past 10 bars. Broke to the low of the past 10 bars, you sold. And then you reversed to long at the high of the next 10 bars. And you lost money, obviously. And we have a new low, so you sell here. Another loss. A new high over the past 10 bars, you buy. You have a small win because this is where you exit, below the low of the past 10 bars. And then look at this. You have a very big win, and it probably offset most or all of the prior losses. And therefore, the strategy is a profitable strategy. However, it's a bad approach to trading because it has a very low Z-score. It has a very low winning percentage. You only had one significant win, and almost all of the profit, in fact, pretty much all of the profit came from a single trade. And that's dangerous. Let's say this is a 5-minute chart, and you had to go to a doctor's appointment right here. Then you would have taken 1, 2, 3, 4 trades so far today, and you would have missed this trade. Let's say it's a daily chart, and let's say you're taking all these trades and you're losing, and you're hoping for this big win. And let's say you went on vacation right here for 2 weeks, and then you missed the big win. That's a big, big problem if you have a system where most of your profit comes from a single win. There's a much higher risk of blowing your account. Any system that needs one big win to make the system profitable is a bad system. There are many brokerage firms that allow you to design and test systems. A very important part when you analyze the results of your system is to pay attention to whether or not most of the profit comes from a single trade or 2 or 3 trades. If you need 1 or 2 big trades for the system to be profitable, it's a bad system and you should not trade it. Even though when you look at the results, it'll say that you made money in the system. You may even have made a lot of money in the system. But if it all comes from a single trade, your risk of ruin is very high. And you probably will eventually lose your account if you continue to trade this system, because you will miss too many of the big trades that you need to offset all of the prior losses. If you miss this one big trade in this series of trades, your system loses money. Another problem with a system where all the profit comes from a single trade is it's hard to wait through bar after bar after bar and loss after loss after loss, hoping for the one big trade. It's hard to take the next trade. You'll look back and say, gosh, I've been losing a lot. Maybe I better slow down in my trading. And you'll end up missing the one great trade that you need to reverse all of the losses and to make the system profitable. A low Z-score means that the chance of blowing up your account is great and your system is bad. You have a low winning percentage. In other words, most trades are losers. You have a few big winners, but more big losing trades, and you're too dependent upon 1 or 2 outstanding trades to offset all of the losses and make the system profitable. Not only do you have to take the trade, you have to manage it correctly, and that's hard to do as well. The result is, if you analyze the standard deviation of your trading results, the standard deviation is very big. You have some very small trades, some very big trades, and that is a very dangerous system. It's unreliable. If you do try trading a system like this, you should trade very, very small. Most traders should never trade a system where you need 1 or 2 big trades to offset a lot of losses, because you're going to lose money. The odds are just overwhelming that you're going to lose. Any system that a beginner trades, he should trade small, because that will reduce the chances of him losing his account. In general, if a beginner can trade small enough to risk 1% of his account on each trade, that is a good starting point. For example, if you have a $10,000 account, try to risk $100 or so on each trade, and not more or not much more. When you're starting out, you're always going to lose, but if you can trade small enough, the cost of learning is not so bad. Even if you have a great system starting out, which you probably will not have, you're still going to lose because you probably will not manage the trades correctly. I mentioned that if you have a $10,000 account and you want to risk about 1% per trade, you would be risking about $100, which is a stop of about 2 points in the E-mini. Even if you have a $10,000 account and your broker might allow you to trade 3 or 4 E-mini contracts, that would generate too much risk, and therefore you should be trading only 1 contract. In general, traders should trade the I don't care size. They should trade so small that they don't care if they lose. All they care about is, am I doing the right thing? Am I trading correctly? Am I managing my trade correctly? Are my setups and entries and exits all logical? And that allows you to practice doing the right thing without worrying about money. You cannot get rich trading the I don't care size. However, you can learn how to trade very well with minimum cost. Even when you become a consistently profitable trader, it's better to be trading the I don't care size, because you want to be doing this for a career. I've been doing this for 30 years, and you have to be happy and you have to be comfortable, and it's not fun to be worried all the time. If you have a $10,000 account and you're a Forex trader, and you want to risk no more than $100 in the euro versus the dollar, then you can use a 100 pip stop and you can trade 10,000 units. That would keep you under the $100 risk. Instead, you could use a 20 pip stop and trade 50,000 units. Or even better, begin trading only 10,000 units so that your risk is only $20 per trade. That's one of the great advantages of the Forex market. Most brokers will allow you to trade very small sizes, which reduces your risk per trade. And your cost of learning is therefore much less. And it's easier to trade a size where you really don't care, or you care so little that you're able to do what you need to do and develop a track record, a style of trading that you trust. And once you're at that point where you can consistently make money, even if it's a small amount of money, then you can begin to increase your position size. Of these two choices, trading with a 100 pip stop or a 20 pip stop, both are good. They're both good I don't care sizes, and they allow you to practice doing the right thing without worrying about money. I've talked many times about the three variables that traders have to consider: risk, reward, and probability. You can look at it as two variables. You can say risk-reward ratio, one variable, and probability, the other variable. Probability is the most important because it's the one that is the hardest to know with any certainty. You always know what your risk is. It's the distance to your stop. You also always know what your reward is. It's the distance to your minimum profit target. Probability is much more difficult. Probability, I think, is the main reason why it's so hard for beginners to make money. That lack of certainty confuses traders, and it scares traders, and they end up making a lot of mistakes. For example, a trader watches a breakout, and they watch an additional breakout, and now they see a bull bar closing on its high, and they think, wow, I've seen enough proof that the market's going up. Maybe I'll finally buy here. That's a common beginner mistake. We're starting to get dojis and bear bars. We have a big tail on the top of this bar. This is a tight trading range, and the big bull bar is forcing you to buy at the top of a tight trading range after 3 legs up on a bull. One, and then 2, 3. Strong breakout, you expect at least one more leg up. However, this big tail and then these 2 bear bars, it increases the chances that we're not going to get much more than 1 leg up. Beginners thought this was a high probability buy, when in fact it was a low probability buy, and the bull trend was probably transitioning into a trading range. Experts were selling here, and they would have sold here as well, expecting that the market is no longer in a bull trend. It's in the early stages of a trading range. The trading range bottom could have been here, but it could be all the way down here at the bottom of the bull trend, which it turned out to be. We got a reversal, spike, pullback channel. Beginners tend to buy too late. Sometimes they buy too early. For example, they might buy here, thinking a double bottom, sell climax and double bottom with this or with that. They buy too early. They buy too late. Both are causes of losses. Another problem with probability is beginners often miss really great trades because they're afraid to risk too much. Here we have a series of bear bars, maybe 10 bars down without a bull body. We have a big bear breakout and a second bear bar closing near its low. This is a high probability short if you sell the close of this bar, that you're going to make some money. You could have gotten out here and made a little bit, or you could have held all the way down here and gotten out down here. This is a high probability trade, but a lot of traders starting out will not take it because they know their stop is up here and they're afraid of risking that much money from selling here all the way up here. Even when they have a high probability trade, they're afraid to take the trade because of risk. When a beginner finally does sell, let's say he sells below this low 1 bear flag, he'll end up exiting too early for a loss or break even. He sells here and he sees a decent bull reversal bar here, a double bottom, maybe a big double bottom, and he buys. And he exits on the reversal up. If you're selling this late in a bear trend, you have to be swing trading, which means you need to use a swing stop, at least above the sell climax, probably above the top of the bear trend, and you have to be willing to hold through pullbacks. This is almost certainly going to be a minor reversal. You have a tight bear channel lasting 10 or 15 bars. The first reversal up, bears will sell it. And bulls who have been buying all the way down and losing are going to use any bounce to exit. So you'll have bulls selling and bears selling, and you'll probably get at least a second leg down. The bears finally got their pullback. A low 2 short, low 1, low 2. You can call it a failed breakout above the double top. First high, second high. Breakout that reversed down, and therefore it's a type of a wedge bear flag. But the beginner still does not sell. He's concerned that we're getting too many bull bars. He ignores the reality that the bull bars are small. There is no series of 2 or 3 big bull bars. Look at the size of these bull bars. They're big, but not compared to that, this, and that, and not compared to the size of the sell-off. This is almost certainly a bull leg in either a trading range or it's a bear flag leading to another leg down. But the beginners won't take the short because they're afraid it's a reversal. It's not. Computers don't trade on emotion, and you can only make money if you follow their logic. When I say they don't trade on emotion, there are some algorithms that look for certain words in Twitter or news feeds, which is a measurement of emotion, but in general, the vast majority of trades taking place are not based upon any emotion. I think this is a very important point. On any chart, any time frame, any market, 90% or more of the bars on any chart are either in a trading range or a broad channel. That means that you can buy or sell at any point and make money if you manage your trade correctly. It usually means using a wide stop and scaling in, but it's possible. 10% of the bars on any chart are either in a strong breakout, like here, or in a relatively tight channel, like there. And a tight channel is a breakout on a higher time frame chart. When that's the case, you should only sell. So 10% of the bars in any chart are in a strong breakout like this, or in a tight channel, and you should only be selling. Certainly a strong breakout, 10% of the bars on the chart are in a strong breakout, you can only sell. Here, theoretically, you might be able to make money. Obviously, the market did not reverse up high enough for buyers to make money. And again, if the market's in a fairly tight channel like that, it's a breakout on a higher time frame chart, and I think traders should only sell. When did it begin a strong breakout? Once you have 3 or 4 consecutive bear bars closing on their lows after some kind of credible reversal, you should assume the market's always in short. Beginners usually lose until they can get free of emotions. It's very difficult to win until you're comfortable with constant uncertainty. And 90% of the bars on the chart, you are going to be certain. 10% of the bars on the chart, you look at it and say, oh yeah, 60, 70, 80% were going lower. But the rest of the time, 90% of the bars on the chart, you're never more certain than 60%, which means the traders taking the opposite side of a trade are never less certain than 40%. That means that 10% of the bars on the chart, the probability of the direction is 60% or higher. 90% of the bars on the chart, the probability of the direction up or down is going to be between 40 and 60%. Every now and then, if you're watching traders on television, they'll talk about what's the direction of the next 100 points, the next 100 pips, the next 100 ticks, or the next 10 pips, the next 50 pips. In other words, is the market going to go up 100 ticks before it goes down 100 ticks? Should I buy for a 100 tick move up and risk 100 ticks to the downside? Or should I sell for a 100 tick move down and risk to 100 ticks to the upside? I refer to that as the probability of an equidistant opposite move. Equidistant because it's X units one way before X units the other way. 100 pips up, 100 pips down. 1% up, 1% down. $1 up, $1 down. For example, at this moment, you don't see all this stuff yet, but at this moment, is it more likely that the market's going to go above that bar? You know the distance. If you sell here, your stop is above that bar. The distance to that line is the same distance here. So at this moment, if you had to buy and put a stop that distance below, looking for a test of that high, or sell, putting a stop up there and hoping for a reward equal to the size of your risk, what would you do? Would you take the buy or take your sell? Well, we're always in short. Once we've had this third consecutive bear bar, always in short. Always in short means it's probably going down. And therefore, the probability is greater that you're going to reach a measured move down from the high to your entry than it is that it'll get to your target. The stop for the bears is up here. Their reward is here. If someone buys here, they're looking for a new high. Their reward is here. And a reasonable stop would be an equidistant move down, so their stop is here. This is the risk for the bears and the reward for the bulls. This is the reward for the bears and the risk for the bulls. I think on the close of this bar, the market reversed always in short. In other words, the probability of making money shifted in favor of the bears. And at this point, if you were forced to buy or sell, you have a much better chance of making money if you chose to sell and putting a stop up there. Once it's always in short, it's easier to make money selling. For example, here we're always in long, it's easier to make money buying. At this instant, would you make more money putting a stop down here, going for a profit equal to the height from your entry price to the stop, Or would you make more money selling here, putting a stop that distance above, expecting the market to fall below the bottom of the breakout? It's more likely that we're going up. Here, the market's always in long. Here, the market's always in short. It's probably going to go here before it hits that stop. I talked about equidistant targets. Now, what about the probability of different size opposite moves? For example, moving X units one way before moving Y units the other way. For example, a computer might estimate the probability of the market going up 0.1% before it goes down 0.13%. Computers obviously want to maximize their profit. When the probability of an equidistant move favors the bears, the system designers are going to try to determine what the best profit target is. It might be better than simply 1 times risk. A bear selling here, here's his risk. This is the same distance, so this is 1 times risk. However, that is not necessarily the best target. The market may fall quite a bit more, especially once you start to see another breakout and another follow-through bar. Computers can make these calculations quickly, objectively, unemotionally, and it's too complex for traders to do. I would not worry about the perfect math. Good math is good enough. As long as you do something that makes sense, it does not have to be perfect. And when you're trading, you cannot focus too much on the math, trying to get every little penny that you can out of the market. It's better to just do something that makes sense and then concentrate on managing the trade properly. Keep asking yourself, is my premise still valid? Is my trade still good? If it's not, then you get out. If it is, you continue to hold your position, and you think about moving your stop, tightening your stop, and adjusting your profit target, making it bigger, making it smaller, depending on what you're seeing. Some algorithms are designed to take more profit when the probability is high, instead of just trying to take profit at 1 times risk. It does not matter what you do, as long as what you do results in a positive trader's equation. In general, 1 times risk is the minimum that you want on any trade, but it's rarely the best. Usually you can get more. This would be a better zone for taking profits, and it could be 2 times risk, it could be 3 times risk. I said before that probability and risk reward is a trade-off. If you're waiting to enter when the probability is high, the risk-reward ratio is going to be worse. On the other hand, if you want trades that have very big profit potential, the probability is going to be less. A high probability trade always comes with a bad risk-reward ratio, because there always has to be a reason for someone to take the other side of the trade. For example, if you're buying and you have a very high probability of winning on your particular trade, the institution taking the other side has a very low probability of winning. There has to be a reason for him to take the trade, and it's going to be he has a very strong risk-reward ratio, and you have to have a very bad risk-reward ratio. Sometimes you can structure a trade with a probability of 80% or more. However, that always means your risk is going to be small compared to your reward, and that you're scalping. Most traders cannot make a living doing that, but I've known many extremely good scalpers over the years who do extremely well doing that. It's just very difficult for most traders to do it. And remember, it's not simply that you can do it, you have to be happy doing it. And there are very few people who can both be profitable and happy as scalpers. We have a strong bear breakout, good-sized bear bars closing on their lows. It's a sell climax, probably a pullback soon. However, when a breakout is this strong, almost certainly you're going to get at least a small second leg down. This could be the second leg down. This whole thing probably was the second leg down. Let's say you sell the reversal up, expecting that it's a minor reversal and a bad buy. It is. Look how many bear bars. And the only bull bar we have, it has a very tiny bull body. This has a very high probability of failing and becoming a bear flag. If a trader sells above this bull bar, betting that the bull reversal is going to fail, his stop at a minimum is at the top of the sell climax, just above the top of the sell climax. He could also put a stop up here if he wants. Both are okay, but this is an acceptable location for a stop. And let's say he exited right here on the test of this low, on this big bear close. The math on that is actually decent. Your actual risk was small. Your reward is at least twice as big as your risk. And you ended up with a small profit, a scalp. The initial risk was about 3 times the size of the reward. He sold at this high, got filled here, and this is where he took his profits. The initial risk was 3 times the size of his reward. If a trader takes this trade consistently, he has to win 80% of the time just to break even. Do you think it's an 80% bet selling the high of this bar? So if you see this trade set up 10 more times, you take it and expect to win 80% of the time? You probably will manage the trade incorrectly. You'll probably diagnose the setup incorrectly, selling trades that are actually going to be good reversals and not minor reversals. It's too easy to lose money. You have to win a very high percentage of the time, which means you have to do a lot of things right. You have to analyze whether or not the trade is acceptable. You have to decide if the premise is still reasonable. You sell this high and then fill it on this bar, and once the bar closes, you look at that and say, I don't know, I was hoping for a big bear bar on this bar when I entered, and I did not get it. Should I continue to hold? Just too many decisions to make, and it's very hard to do all of them well. To be a profitable scalper, you have to do all of them well, because you need a very high winning percentage to make a consistent living, a good living as a scalper. And therefore, traders should not be doing this. I'm looking at charts all day long, and at every tick, every pip, if it's a Forex chart, I see obvious support or resistance or both. If I'm looking at any point on the chart, let's say this point on the chart, I can see where support and resistance is. Resistance is going to be where I'm going to put my stop, somewhere above, and support is going to be an area where I'll look to take profits. High probability of making money if I sell here and I manage my trade correctly. High probability that I can make as much money as I have to risk. In general, if you see a strong breakout like that, you know you're probably going to make money. A 60% chance you're going to make a reward equal to the size of the breakout. Either the high or open of this bar to your entry price here, 60% chance in general, it's going to fall at least that same distance. So let's say you put your stop right above here. And let's say it's 15 ticks if it's a E-mini chart or a stock chart. Or if it's a Forex market, let's say it's 22 pips. Measured move down is here. And if it's the E-mini or a stock, you would get your 15 ticks before your stop was hit. If it was the Forex market, it would have fallen 22 pips and you would have received 22 pips profit while risking 22 pips initially. 60% chance when you took that trade that the market would reach a target equal to your risk, reward equal to your risk. Whenever I'm looking at a chart and I'm trying to assess probability, the only time I'm confident of the probability is during a strong breakout when the context is good. When I see this strong breakout in a bear trend like this, I'm very confident that we're going to go lower, probably a measured move down based on the close of this bar to the open of this bar. And when I say very confident, that means I believe the probability is at least 60% that it's going to fall to a measured move down before it gets to the stop above. Anytime I say, oh yeah, it's probably going down, I have to be 60% certain or more. If I'm less than 60%, I usually will not say, oh, it's likely to happen, or it's probably going to happen. I might say, oh, it's maybe a little bit more likely than not, but it's not all that clear. However, if I look at something and I say, yeah, I'm pretty confident that it's going down, I assume the probability is 60% or greater. If you plug the data into the trader's equation, a reward equal to risk and a probability of 60%, that gives you a positive trader's equation. And that means that if you take any trade and you look at it and you say, oh, it's probably going down, you can go for a reward equal to your initial risk. And it's a mathematically good way to trade. High probability, you don't need a fantastic risk-reward ratio. All you need is a reward equal to your risk to have a positive trader's equation. When the market's in a strong bear trend like this, you can sell for any reason. You can sell bear closes all the way down. You can sell bull closes betting that the first reversals up will fail. You can sell strong bull bars in a series of bars as long as you think the reversal up is still only a bull leg in a trading range or a bear flag, which this is. And you can sell below bars. You can sell below this bar and get filled here, below this bar, get filled here. Use the correct stop, either here or here. You can sell with limit orders, a 50% pullback from this breakout. From this high to that low, 50% pullback. You can sell with a limit order right there. You can sell with a limit order above this bar. You can sell with a limit order above this bar. Here's a small double bottom. And you can bet that the breakout above the double bottom will not get very far. So you can place a limit order to sell at this high and you get filled right there. It doesn't matter what reason you use to sell. You next have to analyze where is a logical place for the stop. The top of the sell climax, the top of this bear breakout is a good place. You could also put a stop up there. And you know how far your entry price is. If I sold here or if I sold here, I can figure out how many ticks or how many pips I'm risking, and then I should set my target, my profit-taking target, at that same number of ticks or pips, knowing that I'm looking at this and I'm saying, yeah, it's probably going down. That tells me that I'm at least 60% certain that it's going to go down for a move equal to my risk, and therefore I have a good location for taking profits. We're in a bear trend. We have a wedge bear flag here, low 1, low 2, low 3, and now we have either a low 1 or you can call it a double top bear flag with this high and that high. Most double tops are not at the same level. And let's say you wanted to sell below a bear bar, so you sell right here. Where should you put your stop? In general, above the top of the most recent major lower high. Is this a major lower high? No, a major lower high has a strong breakout and usually a new low. This is, I think, a major lower high. This is clearly a major high. This is a reasonable place for a stop, but most traders selling down here probably would want a tighter stop, for example, above the top of this most recent bear breakout. High probability that the market's going to go down, and your stop is here. Let's say your stop is 13 ticks above the entry price, if it's a stock or the E-mini. On the other hand, let's say it's the Forex market and it's 18 pips above. It doesn't matter. Whatever that distance is, you're looking at a high probability trade, and therefore you can go for a profit target that is equal to your risk. Here's a measured move down from the stop to the entry price. This is the measured move down. If it was a stock, I said this could be 13 ticks, then your target is 13 ticks. If it's a Forex market and this was 18 pips above your entry price, then your target is 18 pips below. You look at this and you know the market's in a bear trend, 60% certain it's going to go down at least as far as your risk. Therefore, selling below this bear bar, getting filled here, putting a stop here, a reasonable stop, has a 60% chance of reaching this profit target. I talked about a Z-score, which is a mathematical way to measure how good your system is. In general, if you're testing a system and almost all of the profit comes from 1 or 2 trades, that is a bad system. You want a high winning percentage and you want rewards that are fairly consistent. You don't want all of your profit to come from 1 or 2 trades because the risk of blowing your account, ruining your account, being unable to trade without putting more money in the account then becomes high. All traders are always choosing between a trade with high probability or a trade with strong risk reward. You simply decide which is more important to you. Of the variables, probability, risk, and reward, risk and reward are always known. You know where your stop is. You know where you want to take profits. Probability is not always known. However, 10% of the bars on the chart, the probability is 60% or higher. For example, a strong breakout. 90% of the bars on the chart, the probability for a bull or for a bear is going to be between 40 and 60%. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on the trader's equation and probability. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on the trader's equation and probability. I want to start by talking about the importance of a 50% pullback. Also, the math for a trade can improve after there is a breakout. We have a bull trend, decent breakout, and then a pullback. Because there's a strong bull trend, if there's a 50% pullback, there's the low of the bull trend, there's the high of the bull trend, here's a 50% pullback. There's a 60% chance of at least testing the high before hitting a stop if a person were to buy that 50% pullback. A bull trend means it's more likely that the market will continue higher. Obviously, if it reverses all the way to just above the bottom of the bull trend, the probability that it will get back to the top is small. But as long as it's pulling back to about 50%, there's a 60% chance that it will get here to the top of the bull trend before it gets here to the bottom of the bull trend or just a little bit below and hit a protective stop. Many bulls will place a limit order to buy a 50% pullback. Most would not get filled here. It usually has to fall below the limit order to get filled, and they would get filled on this bear bar. Other bulls prefer to buy on a reversal up from a 50% pullback. Here we have about an 8-bar bear microchannel. A lot of bulls would wait for a second entry buy, and here they have a bull body. They would buy on the reversal up above that bull body. A micro double bottom, a second entry, here's the first entry there. These buys have a 60% chance of leading to a rally up to here before a sell-off down to here, because what preceded this sell-off was a bull trend. Buying here, it's halfway to the target and halfway to the stop. It's a little bit further to the stop because the stop is just below the bottom of the bull trend. The reward up to the high is equal to the risk down to the stop, maybe a little bit more to the stop. Strong momentum up, so the probability is that the market's going to go up here before it'll come down here. And because of that, bulls buy at a 50% pullback. The reward is equal to the risk, but the probability is 60% or higher. That is the basis for traders buying 50% pullbacks from strong trends. The bulls got a breakout and there's a double top. It broke below the neckline of the double top in a very strong sell-off. 5 consecutive bear bars, this one being very big, closing far below the low of the past 50 or 60 bars. The odds are traders will sell a 50% pullback. Bears who are short, for any reason, selling down here, selling a 50% pullback. It doesn't matter. Their stop is above the top of the bear trend, up here. The minimum target for the bears, whether they sell the close, sell the 50% pullback, or sell below the reversal bar, down and get filled here, is down here, a new low in the bear trend. The risk to the stop is about the same as the reward to the target, the new low. Yet, because the sell-off was so strong, there's probably a 60% chance that the market is going to fall here before it's going to go there. Risk is equal to reward, but probability is maybe 60%. Therefore, selling a 50% pullback in a strong bear trend is a very good thing to do, a very good trader's equation. Often when you get a 50% pullback, the momentum up is so strong that you think that the market is reversing into a bull trend. However, as long as it does not get much above that 50% pullback, chances are this is a bull trap, trapping inexperienced bulls into buying too high when the market is still in a bear trend and this is simply a pullback, 2 legs up, 1 pullback 2. Look at the bad follow-through after the strong bull bar and the tail on the top of the bull bar. This is simply a test of this breakout point and a test of the 50% pullback. Chances are the market's going lower even though there's a strong bull bar. Bears who short here, the distance to their target, their reward, is the same as the distance to their stop, their risk. But the probability of making their reward is maybe 60%. Even though the risk is equal to the reward, the probability makes this a very favorable trade, a very positive trader's equation. We have a strong sell-off, maybe about a 10 or 15 bar bear microchannel, no bull bars in about 10 or 15 bars. Traders will sell a 50% pullback. Some will place a limit order at 50%. This is 50%. They'll sell with the limit order. Others will sell on a reversal down. When you have a strong bear trend and a pullback to about 50%, there's a 60% chance the market is going to test the bear low before there's a rally up to the top of the bear trend. In this particular case, the stop is 1 tick above the top of the bear leg, and that's 4.75 points above, and the reward is 4.5 points below. This is a positive trader's equation. Reward equal to risk. Actually, the risk is one tick bigger because the stop is one tick above the top of the bear leg, and the probability is 60%. Stop above the top of the bear leg. Some traders will simply place a limit order to sell a 50% pullback and put a stop above the top of the bear leg. Others will sell a reversal down or a second entry short or a third or fourth entry short, looking for a test of the bear low. Since the probability is 60% that the market will get here before it gets here, since it's a bear trend, there's a 60% chance of making 10 ticks before losing 10 ticks, 20 ticks or 30 ticks before losing 20 or 30 ticks, and a move down to the bear low before moving the same distance up to the bear high. The trader's equation is positive. In general, when you have a high probability trade, the risk-reward ratio is bad. In other words, the risk-reward ratio is maybe 1 to 1. That means that the reward is usually not bigger than the risk or not much bigger than the risk. It usually means either a big risk or a small reward or both, or reward equal to risk, not much bigger than risk. Even if you sell this for a scalp, you have a positive trader's equation. Let's say you're looking to scalp for 1 or 2 points and use a stop of 1 or 2 points. Chances are, if you enter at a 50% pullback, any number of ticks down, let's say 7 ticks down, you'll get there before it goes 7 ticks up. 15 ticks down before it goes 15 ticks up. In general, it's better to take this as a swing trade, looking for a test of this low and putting your stop up here. That is the most reasonable stop, the top of the bear trend. This is the euro versus the dollar, a 5-minute chart. And there's a strong reversal, strong bull breakout, 3 consecutive bull bars. A lot of traders will place a limit order to buy at a 50% pullback or on a reversal up. Because the trend is strong, if you buy a 50% pullback, there's a 60% chance that the market will get to the top of the bull trend and test the bull high before it falls below the bottom of the bull trend and hits a stop just below that low. In this particular case, it's 32 pips to this high and 32 pips to that low. The stop is 1 pip below. There's a 60% chance, approximately, of reaching that high and making 32 pips before it hits a stop below this low, 33 pips below. Even though the reward is equal to the risk and is not twice the risk, the 60% probability of success makes the trader's equation positive, and therefore, mathematically, it's a good trade. The stop is just below the bottom of the bull leg. Bulls will either buy with a limit order at a 50% pullback or on the reversal up. Very often when you get a 50% pullback in a reasonably strong bull trend, the sell-off is so strong it looks like the bull trend is failing and it's reversing. However, the odds are that if you take the 50% buy, you're going to make money, even if the reversal down is strong. Reasonably strong bull reversal, 60% probability that you make 32 pips before your stop is hit 33 pips below. In fact, you could make much more than 32 pips. In this particular case, the trader would have made much more before losing 32 pips. Therefore, the reward is much better than simply 1 to 1. Swing bulls will buy this 50% pullback, put a stop down here, and they'll just hold until their premise is no longer valid. Maybe they'll get out here, maybe they'll get out here. And if they do, their reward is much bigger than their risk. That's an even stronger trader's equation. Here we have a bull leg. It's 52 pips tall, and we have a pullback that's 28 pips down from the high. Strong enough bull breakout probably will test that high. Buying with a limit order at a 50% pullback, a trader has a 60% chance of testing the high, making 26 pips, before the market goes down and hits the stop, 1 pip below the low, 27 pips. Therefore, a bull buying here has a 60% chance of making 26 pips before losing 27 pips. That is a positive trader's equation, and therefore, mathematically, it makes sense to take the trade. Stop is below the bottom of the bull leg. Some traders place the limit order to buy at 50%. Other traders buy a reversal up. Here we have a high 2 buy, high 1, and then a second entry, high 2. Whenever you have a 60% probability, you have a high probability trade. That means that you have bad risk-reward. Bad risk-reward means that you have a reward that's small relative to the risk, or a big risk. In general, anytime the reward is less than 2 times the risk, I call it a bad risk-reward ratio. But I often take trades where the risk-reward ratio is 1 to 1. The reward equals the risk, if the probability is 60% or higher. Even a scalp has a positive trader's equation. For example, if you buy this and place a stop 10 pips down, looking to take a 10 pips profit, chances are 60% that you'll make money. What about buying this and putting a stop 13 pips down, looking to make 13 pips? We're in a bull trend. Chances are you'll make a reward equal to your risk, as long as your risk is no more than this stop below the bottom of the bull leg. It doesn't matter if it's 5 pips, 10 pips, 15 pips for the risk, and 5, 10, or 15 pips for the reward. 60% chance you'll make your reward before your stop is hit. Many traders like to enter early because the risk is less and the reward is greater. Other traders prefer to enter after a strong breakout, when the probability is higher. The math can actually be better after a strong breakout. Here we have a trading range, and the bulls are trying to get trend resumption. Bull trend, trading range, bull breakout. 3 bull bars here, a bull bar here, closing above the top of the past 50-bar trading range. The context is good for trend resumption up. The market's in breakout mode. We have 3 bull bars here, and now we have a pretty good sized bull bar. 60% probability, maybe even more, that a trader buying that close will make a reward equal to or greater than the risk. He would put a stop either below that low or below this low, and 60% chance he'll make his profit before his stop gets hit. So let's say a trader buys the close of that bull breakout bar. He can put his stop 1 tick below the bottom of the bull breakout bar. The market usually will not fall below the bull bar if it's going higher. Sometimes it'll pull back below that bull bar and continue up. Most of the time, if it's going higher, it will not fall below the low of that breakout bar. In this particular case, if you buy that close and you put your stop below, your stop is 8 ticks below your entry. Since you're risking 8 ticks to below the bottom of the bull bar, your minimum reward should be 8 ticks above. And the breakout is strong enough so that there's a 60% chance if you buy that close, you'll hit this profit target before you hit that stop. Therefore, the trader's equation is good. Let's say you chose not to exit and instead looked at this as a swing trade. This is where you would have exited. This was your 8 ticks profit target. But let's say instead you held long. As the size of the breakout grows, so does the size of the target. For example, let's say you bought the close of this bar. Now your stop is still here, but your target is a measured move base from that close to this low, and your target is now here. Some bulls keep buying closes. The stop is still down here. But since this is a reasonable breakout entry, chances are 60% the market will go for a measured move up before it hits the stop below the bottom of the bull breakout. If you buy that close, your stop is still here, but now you have a 60% chance of making a 14 tick profit. Your stop is now 14 ticks below that close. So 60% chance if you buy this close, you're going to get there and make 14 ticks before it hits your stop down here. The bulls who bought this close and held, and now the market is here, they have a 60% chance of making 14 ticks above this close, which is 20 ticks above their original close, while risking only 8 ticks. They bought that close, their stop is still 8 ticks below their entry price, but now that we have this close, the market has a 60% chance of getting here. So these bulls have a 60% chance of making 20 ticks before an 8 tick stop is hit. So excellent trader's equation at this point. The math is getting better as the breakout continues. We have another bar in the breakout. Some bulls will buy that close, stop down here. The breakout is strong. 60% chance the market will go a measured move up from this close to that stop before it gets to that stop. The stop for these bulls is 23 ticks below the low of the bull breakout, and therefore they have a 60% chance of the market going 23 ticks higher before it goes 23 ticks down. Very good trader's equation for buying that close. They buy that close, and their new target is 23 ticks above, 60% chance it'll get here before it hits their stop down here. What about the bulls who bought this close? Well, their stop is still 8 ticks below their entry, but now their target is 38 ticks above their entry. So they have a 60% chance at this point that they'll make 38 ticks while risking only 8 ticks. They bought this close, and as the breakout continues, their reward gets much, much better, but their risk stays the same. And the probability stays the same. Once we're at this close, 60% chance measured move up. Once we're at this close, 60% chance measured move up. The risk stays the same, the probability stays at 60%, but the reward grows. As the breakout continues, the math gets better and better for the bulls who bought that first close. The bulls who bought here, their minimum target is here, equidistant to their stop, 23 ticks. They could get out right here and have a positive trader's equation. Reward equal to risk, probability when you buy here, 60% that you'll get to your target before the market hits your stop. You can see the tail above the pink line, and that means there was some profit taking from the bulls who bought that close. The bulls who bought this close never had more than an 8-tick risk. Their risk was always to just below the bottom of the bull breakout. No matter how big the breakout went, that's where their stop was. Once you have a major high or low, a reasonably strong breakout to a new high, they might raise their stop, but certainly their initial risk was only 8 ticks, yet their reward was way up here. Once we had this close, they had a 60% chance of making 38 pips. And you can see some traders took profits here. That's what caused that tail. This is a 60-minute chart of the dollar versus the Canadian dollar. We're in a bear trend, a very tight bear channel, very few bull bars, and they're all small. Now we're getting a bear breakout, a big bear bar, closed below the low of the past 50 or 60 bars. Probability is we're going to go lower, at least to a reward as big as the risk. Strong breakout, good context. That means high probability, 60% or more, that traders selling this close will make a reward equal to their risk. Even a scalper going for a small reward has a 60% probability of making a reward equal to his risk. For example, if he's scalping for 12 ticks while risking 11 ticks, 15 ticks while risking 15 ticks. 60% chance he'll reach his target before his stop is hit. That's the minimum goal. Most traders should still swing trade and try to get a reward at least 2 times their risk. A trader could sell this close, maybe put a stop just above the top of the bear leg, or stop above the top of the bear breakout. If this is going to be a successful swing down, it should not get to the top of this bear bar. If you sell that close and your stop is here, just above the high of the bar, you're risking 19 pips. Because the breakout is strong and the context is good, 60% chance it'll fall 19 pips from your entry before it rallies 19 pips to your stop. Sell that close, stop up here, 60% chance we're going to fall to this level, a target equal to the risk. Tight channel, a breakout on a higher time frame chart. Some traders instead will sell this close. Their stop is still above the top of the bear breakout. Their risk is greater, but there's still a 60% chance the market will fall for a measured move. Therefore, their profit is greater as well. A sell the close bear trend, so bears keep selling closes. They don't sell every close. Some will sell this close, others sell this close, others sell this close. No matter which close you sell, 60% chance the market will fall for a measured move from your entry to the stop. The stop is still 1 pip above the top of that bear breakout, even if you sell here. But the bears who sold here are now risking 34 pips. They have a 60% chance that the market will fall 34 pips before it hits that stop. Here's the minimum target. The bears who sold here, they're still only risking to this line, which is 19 pips. These bears are risking 19 pips. Since there's a 60% chance at this point that we're going to fall here, the bears who sold here now have a 60% chance of making 49 pips while risking only 19 pips. As the breakout continues, the math for these bears gets better and better and better. Their risk stays the same, but their reward continues to grow as the breakout grows. These bears should not be too quick to take profits because their target keeps getting further and further away. The reward continues to grow as the breakout grows. It's still a sell-to-close bear trend, a bear microchannel, no pullbacks since over here. Reasonably strong breakout. Some bears will sell that close, and their stop is above the top of the bear sell climax, which is 1 pip above this bear bar. Their stop is 59 pips above their entry. They sell here, stop here. They're looking for a measured move down, 59 pips below, and because the breakout is strong and the context is good, they have a 60% chance of the market falling 59 pips down to here before it rallies 59 pips up there. The bears who sold here, their stop is still only 19 pips. But once the market is here, there's a 60% chance of it falling here. These bears now are risking 19 pips and have a 60% chance of making 99 pips. As the breakout continues to grow, their probability stays 60% that they'll make a measured move based upon the current close to the stop, and their risk is still here. So their risk stays the same, the probability stays the same, but as the breakout grows, their reward gets bigger, and therefore selling here and holding as the breakout continues, you improve your trader's equation. The math gets better. Strong reversal up at the measured move target based upon the last close of the sell-to-close bear trend. That tells you that a lot of traders took partial profits, maybe full profits, at a measured move down from that close to where the stop is. You can see when the market got there, there was a lot of buying. And a lot of that buying is bears taking profits, and some of it is from bulls knowing the bears will take profits, so the bulls buy for a scalp. The bears who took the first short and held never had more than 19 pips risk. Their stop was above the high of that initial big bear breakout. When they initially sold, they had a 60% chance of making 19 pips before a stop was hit. At this point, they had a 60% chance of making 99 pips before their stop was hit. I began by talking about the importance of a 50% pullback in a strong trend. If you're in a strong trend and you have a 50% pullback, chances are 60% or higher, the trend will resume and test the extreme of the trend. For example, in a bull trend, it'll test the high before it hits the stop below the low. If you're entering in a strong breakout and you hold as the breakout continues to grow, your math actually improves. Your probability stays at 60% of a measured move profit. Your risk remains the same, but as the breakout grows, the measured move target grows, and that means the reward grows as well. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on the trader's equation and probability. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on the trader's equation and probability. Believe it or not, every trader is 90% certain that they will reach their profit target. And I think that's interesting, and most traders do not think about it. But when the market gets very close to your target, your stop is far away, yet you continue to hold your position and rely on your stop. You can only do that if you're 90% certain that your target will be hit before your stop will be hit. I think it's really important to understand the 40 to 60% rule. During 90% of the bars on any chart, traders can buy or sell at any time and make money if they manage their trades correctly. Finally, I want to talk about the probability within a trading range. It's high for the bears near the top. It's high for the bulls near the bottom. Let's say you bought a 50% pullback from this bull breakout, and you're looking to take profits on a test of the high. Your stop is below the bottom of the bull breakout. And let's say you have a limit order to take half off if the market gets back to the high. Let's say the market is racing up as it did, and it hits your limit order, but did not go above your limit order. Usually the market has to go at least a little bit above your limit order before it gets filled. But the instant that it hits your limit order, you're usually not filled. Think about that. The market usually has to go at least one tick above or one pip above the limit order before you get filled, before you can sell for a profit. Yet, what do? The market just hit your limit order, you're not filled. You're going to hold for a few more seconds at least to see if you get that one additional tick or pip that goes above your limit order so that your order will be filled. Yet, your stop is still all the way down here or maybe here. So you're risking far more than 10 ticks or 10 pips to make that final one tick or pip. You can only hold on to your trade if you believe that the probability of making that one tick or pip is at least 90%. Otherwise, you cannot risk down to here or down to here to make one tick or one pip. You need that 90% certainty to have a positive trader's equation. And that means that on almost any trade where you have a limit order to take profits, at least briefly, you are 90% certain about the probability of making a profit. Whenever the probability is very high, the risk reward has to be terrible. There has to be an institution willing to do the opposite of what you're doing. If your reward is only one tick or one pip and your risk is 10 ticks, 10 pips or more, obviously that's a horrible risk-reward ratio. However, a horrible risk-reward ratio goes hand in hand with a very high probability of success. Usually when you have a very small profit target, you have a very high probability of success. The opposite of that is also true. If you have a very tight stop, you have very low risk, you're always having a very low probability of making a profit. So tight stops usually lose. Small rewards usually win, but your risk is big. Let's go back to this bull. It just hit his limit order and it's not yet filled. It needs to go one tick or one pip higher for him to get filled. Yet his stop is here or here. The reward at this point is only one tick or one pip if it's a Forex trade, yet the risk might be 10 ticks, might be 20 or 30 ticks or 20 or 30 pips. You're a rational trader. A rational person can only do that if he's very confident that he'll get his profit before his stop is hit. And that means that you have to be at least 90% certain that you're going to make your reward before your stop is hit. And that means that on almost every trade, at least briefly, you're 90% certain of something. When the market gets to your limit order and does not yet fill it, and you continue to hold your position, yet your stop is far away relative to your reward, you have to be 90% certain that you'll get your reward before your stop is hit. Let's say that your risk is greater than your reward. Let's say you're using a wide stop and you're scalping. Most traders cannot do that because they have to win 70% of the time just to break even. And therefore, most traders cannot profitably scalp day after day, year after year. As a result, most traders should look for swing trades. A swing trade, a reward at least twice as big as your risk. That is the single best way for traders to become consistently profitable. Some traders can comfortably scalp for their entire careers, but that is a very small number. The vast majority of profitable traders cannot scalp profitably, and they cannot do it comfortably. A lot of very experienced traders can scalp, but they hate it. They're stressed out, it's not fun, and they don't do it. They would rather swing trade. These are all reasonable scalps, selling below here for a scalp, buying above here for a scalp. These are all selling, buying, 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 buying. On a chart with about 70 or 80 bars, there are 8 or 9 obvious scalps. There are actually many more if you include limit order scalps, but most traders cannot take all of those trades, and they certainly cannot be happy trading taking all of those trades. If you look at it, it looks like a good day. You sell, you buy, you sell again, you buy, and you end up with a lot of profitable trades. However, a lot of those traders, especially if they're beginners, if they took this sell, they probably would have taken that buy and this buy, and they would have sold here, and they would have bought here, and all of these gold boxes were losers. And that's the problem with scalping. It's easy to look at a chart and find all the winners. If you're trading it real time, you would have taken a lot of these losers as well, and they would have more than wiped out all of your wins. Remember, if you're scalping, you have to be 70% profitable or better to make a living doing that. Again, there are some traders who do that. I know a lot of traders who win 90% of the time. They're very profitable scalpers. That's unrealistic for most traders. Most traders have to swing trade to be consistently profitable. These blue boxes are the winners, and a beginner who took those scalps probably took a lot of the gold boxes. He would have had 8 winners, 8 blue boxes, and he would have had 12 losers, the 12 gold boxes, and he would have ended up losing money by the end of the session. An experienced trader can make money scalping during a strong breakout, and many will scale in lower. You can see the video on scaling in. For example, we have a strong breakout here, a buy climax. Traders will buy the close of a strong bull trend bar. They can buy any of these closes, but let's say a bull bought this close. His initial stop is below the bottom of the major high or low, the bottom of the buy climax, the bottom of the breakout. Remember, every trend bar, every series of trend bars is a breakout and a climax. This is the initial risk. The trader was willing to risk all the way down to below the bottom of the bull breakout. A lot of traders will buy more lower. If they do, they want their second entry to be at least a scalp below the first. That's because many will get out when the market gets back to their first entry. They get out break even on their first entry and then with a scalp profit on their second entry. Other traders will continue to hold for a reward equal to at least 1 times their actual risk. If a trader takes this buy, buys more here, and the market starts to turn up, he might raise his stop from here to here. And his actual risk then would be from his entry price to below the low of this bar. His actual risk might be less than that depending on when he entered. If he entered with a limit order here, the market traded down to here and reversed up, that means his actual risk was to just below the low of that bar. This is his actual risk. If he buys here, and his actual risk is here, he's in a bull trend, he has a 60% chance of making at least a reward equal to his actual risk. Some bulls will buy here, some will add on here, some will just continue to hold long, and they'll get out at 1 times their actual risk. And because the probability is 60% or higher that a bull buying here will make a reward equal to his actual risk, it's a good trader's equation. Buy here, whether or not you add on here. If you buy here and the market starts to go up, your actual risk was right here. You have a 60% chance of making at least that reward if you exit at that point. Even though you're taking profits at only 1 times your actual risk, the trader's equation is positive because you're buying in a strong bull trend. There's a 60% chance that you'll make a reward that is equal to your actual risk. And with a risk-reward ratio of 1, if the probability is 60%, the trader's equation is positive. You often hear me talk about the 40-60 rule. When I talk about the 40-60 rule, I mean that 10% of the bars on any chart are in a strong breakout, and there's more than a 60% probability that the trend will continue. On the other 90% of the bars on the chart, the probability is really not all that clear, and the setups are not as strong as you want them to be. For any trade during 90% of the bars on any chart, there's a 40 to 60% probability of the market moving X units in one direction before it moves X units in the other direction. 90% of the time on any chart, the market's in either a channel or a trading range. Only 10% of the bars are in a strong breakout on any chart. When the market's breaking out strongly, traders should only go in the direction of the trade. Strong breakout, only buy, only buy, only buy, only buy. If the market's not obviously in a strong breakout, then it's either in a channel or a trading range. And that's true for 90% of the bars on every chart. When that's true, the probability for the bulls and the bears is always going to be between 40 and 60%. Buying or selling, the probability is never worse than 40%. Buying or selling, the probability is never better than 60% that you'll make X units before you lose X units. 10 pips, 10 ticks, up or down. 25 ticks, 25 pips, up or down. 40 to 60% chance. Strong, successful breakouts with decent follow-through are rare and they're brief. They don't last all that long. And during those times, the probability that the market will continue in your direction, at least a little bit, is high, more than 60%. 90% of the bars on the chart are not in strong breakouts. And during 90% of the time, inside these blue boxes, the probability is going to be 40 to 60% for the bulls and bears, usually between 40 and 50%. You never have to know the probability exactly, and that's because of the trader's equation. Most traders should be swing trading, and that means they should be going for a reward at least twice as big as their risk, and they only need a 40% probability for that to be a profitable trade. And since 90% of the bars on the chart, whether you buy or sell, you have at least a 40% chance of making a profit. If you go for a reward that is at least twice as big as your risk, you have a profitable strategy. During the green boxes, you have better than a 60% probability the market will continue in that direction. During the blue boxes, your probability is 60% or less, but it's not less than 40%. The green boxes only trade in the direction of the trend. Blue boxes, you can make money buying or selling as long as you go for a reward 2 times your risk. That risk-reward ratio results in a positive trader's equation even if the probability of success is only 40%. That's very important to know. That tells you that 90% of the time, you don't have to worry about the probability. Just assume that it's at least 40% for buying or selling, and as long as you go for a reward at least twice your risk, the math is good. You have a positive trader's equation. Buying or selling anywhere in here, or in here, or in here, you have at least a 40% chance of making a profit if you go for a reward twice as big as your risk. You determine what your risk is by placing your stop, and as long as you go for a reward that's at least twice as great, you're going to have a positive trader's equation, even if you win only 40% of the time. Therefore, 90% of the time when the market is not breaking out strongly, always go for a reward at least 2 times your risk. That compensates for whatever low probability you have, and it results in a positive trader's equation, and it's a profitable strategy. Your probability is never going to be less than 40% buying or selling during 90% of the bars on the chart. When you're in a strong bull breakout, you should not sell. You should only buy. At the times when you're not in a strong breakout up or down, you can buy or sell and make money because you know the probability of buying or selling is going to be at least 40%. Remember, you can buy or sell, and that means both the bulls and the bears can have a positive trader's equation. The probability of most swing trades is only between 40 and 50%. And that's true of a trader swing trading in the opposite direction as well. If you're buying, 40% chance you make money for a swing trade, and the institution taking the opposite side of your trade, if it is swing trading as well, it only has a 40 to 50% chance of making a profit, or making a reward 2 times the risk. Both of you have a good trader's equation. Both the bulls and bears can lose more than 50% of the time and consistently make money, as long as their reward is at least twice their risk. Since you can buy or sell during 90% of the bars on the chart, the key to making money is money management. You have to use a reasonable stop, reasonable risk, and you have to try for a reward that is at least twice as big as your risk. That good risk-reward ratio overcomes the low probability. Remember, your probability is always at least 40%, but often it is only 40%. If you have a reward that is at least twice your risk, if that's your target, that overcomes the low probability and keeps the trader's equation positive. Here we're in a bear channel. We have 4 pushes down. 1, 2, 3, 4. So it's a high 4 buy. You can look at it as consecutive bottoms. So we tried to get a bottom here, but we have a bear breakout. And we tried to bottom again, and then a second attempt at a bottom. And this is a micro double bottom. Down, up, down, and then trying to go up. Chances are the market's going to have 10 bars, 2 legs, sideways to up after a high 4 buy at the bottom of a channel. We have consecutive complex bottoms. We tried to bottom 1, 2, tried to reverse up. We got a bear breakout, tried to bottom again. 1, 2, complex bottom, 2 attempts up. A bear breakout, complex bottom, 2 attempts up. We have a micro double bottom as well. Probably going to get at least 10 bars, 2 legs, sideways to up. TBTL, 10 bars, 2 legs. We sold off in a wedge, 3 pushes down, 1, 2, 3. And we're trying to reverse up at the signal bar high over here. And we have a decent bull signal bar here and a micro double bottom with also a good bull bar. We have a micro double bottom with a good buy signal bar here and another good bull bar here. This is a reasonable buy, looking for at least a small second leg up. It's also a higher low major trend reversal. Bear trend, strong bull breakout to a higher low, and a wedge bull flag, 3 pushes down, 1, 2, and then 3. The bulls got their minimum goal. They have a second leg sideways to up. Here it's mostly sideways. Yet look what's happening now. We have a potential triangle, 3 reversals down, 1, 2, and 3. The bears have a good signal bar and a decent entry bar. The bears also look at this as a double top, lower high. A double top, the second high is a little bit lower. It therefore is a low 2 sell signal below the low of this bear bar, getting filled right here. As is always the case when the market starts to go sideways, there is a decent buy signal and a decent sell signal. In this particular case, the bulls who bought here probably have to exit. They have a double top, lower high, and a good sell signal bar, and they have their second leg up. Because the bears have a reasonable sell signal, a triangle, and a bear trend, and a decent sell signal bar, and the bulls got their second leg up, the bulls exit, and the bears will sell, looking for a swing down. And the bears got their swing down. Here we have a bull trend, a bear break below the bull trend, and we have a lower high and another lower high. The bears have a decent sell setup for a swing down, a lower high major trend reversal, even though we're still in a bull trend. In addition, they have a small double top, and this double top is a lower high. So it's a double top, lower high major trend reversal. That's a common pattern in a tight trading range. When you have a tight trading range and there's a double top and a lower high, sometimes it's a higher high, but usually it's a lower high. It's a reasonable short, 40% chance you'll get a swing down. For the bulls, this is a bull trend, a bear breakout, but this is a bull flag. This is a breakout of the bull flag, and this is a pullback from that breakout, and it's creating another bull flag, small bull trend, and then a double bottom, this low, that low. The market's been sideways for about 50 bars. There's always going to be a reasonable swing setup for the bears and a reasonable swing setup for the bulls. The bears who sold here or here, they will get out above this bull bar. We have a decent bull bar here, and then a second entry here. The bears will give up and the bulls will buy. We have a bull trend, a bear reversal, but it's a bear channel, a bull flag, and then we have a bull breakout, and this whole bear channel is a pullback from this bull breakout. And now we have a high 2 buy and a higher low. The market's still always in long. The bears get out and the bulls buy, looking for a swing up. There's also a small triangle. Whenever there's an II, this bar is inside that bar, this bar is inside that bar, and this bar is inside that bar, so it's an III. It's always a triangle on a smaller time frame chart. You don't have to look. You just assume whenever you see an II or an III that it's a triangle on a smaller time frame chart, and therefore a breakout mode pattern on this chart. It's a nested triangle. We We have a reversal down, a second reversal down, maybe a third reversal down, maybe a third reversal down here. So it's a large triangle, a nested triangle, a small triangle, and a bigger triangle. It does not matter if you call this a triangle or a tight trading range. The implication is the same. If the market goes sideways for 20 or more bars in a pullback, the pullback is a trading range. Here we have a pullback lasting 20 or 30 bars. Now it's lasted 50 bars, 60 bars. 50% chance the bull trend will resume up. 50% chance you'll get a reversal down from the higher low major trend reversal. I've taught thousands of traders how to trade using price action. And if everybody knows it, how can it work well? Because everything looks easy until you're actually trading it with real money. And the margin for error is very small, and every little mistake works against you. And therefore, it's very difficult to trade consistently well. You can do it, but it takes practice. And those who understand price action better, those who manage their trades better, have a better chance of making money. Even the best analysis is only going to be right 60 to 70% of the time, and you're competing against the smartest people in the world. You often hear traders talk about trading as a zero-sum game. In other words, every dollar lost by you is made by me, or vice versa. It's not entirely true. You have fees, you have slippage, you have other costs, overhead costs like bid-ask spread, so it's not exactly zero-sum. Also, the world economy has been growing since the beginning of the world economy, and therefore more dollars are going into the economy, and therefore it's not a zero-sum game. The pie keeps getting bigger. But over the short run, a day, a week or so, it is a zero-sum game. Because over the short run, it is a zero-sum game, all you have to do is be better than the average trader to consistently make money. You can study a great trader. Warren Buffett is probably the greatest trader of the past 50 years. And you could watch him every minute of every day for a year and then try doing what he's doing on your own, and you'll still lose money because it takes a lot of experience. You could watch someone play the violin for a year and then try to play the violin, and you'll sound terrible. It just takes a lot of experience. Soccer as well. There's a big difference between knowing how to play soccer and knowing how to play it well enough to make a living, to have people pay you to do it. So it does not matter if everyone knows basic price action. Can they apply it, and can they manage their trades well? That's the difference between making money and not making money. If you ever play poker, every player quickly decides who the weakest player is. That's the easiest person from whom you can take money. They're going to lose all the time. That person is the mark. In general, if you're playing poker and you don't know who the mark is, then you're the mark. You're the person everyone's trying to take money from. In trading, if you don't know price action well enough to understand who's going to be trapped in a trade, you'll soon discover that it's you. You really have to understand price action to trade profitably. It's really important, whenever you take any trade, to believe that the exact opposite of what you believe is going to happen at least 40% of the time. Because that's true. The probability is always 40 to 60% during 90% of the bars on every chart. And therefore, no matter how certain you are that the market's going to do something, there's at least a 40% chance that it's going to be the opposite. The market was in a bear trend here. The bears can argue a nested wedge, 1, 2, 3, a bigger wedge, 1, 2, and then 3. You can call it a double bottom, 1, 2, and a decent bull bar, and it's a second entry buy. A decent bull bar here. It triggered by going above that. Now we have a second entry buy. And a lot of bears will exit here. The channel is tight. They know the reversal is probably minor, and it will result either in a bear flag or a trading range. We're going sideways. The bulls are hoping that this is a bear trend, bull breakout, and a double bottom, higher low, major trend reversal, or a head and shoulders bottom, left shoulder, head, right shoulder. Again, it's reasonable to exit there as well. Another attempt at a double bottom or a higher low major trend reversal and a good bull bar. You can call it a triangle if you want. 3 reversals up, 1, 2, 3, in a horizontal trading range. Good traders, if they get trapped out of a good trade, are always looking to sell again. The market stayed always in short all the way down, and therefore, if a bear exit, he needs to sell again below a bear bar, so he'll sell below that bear bar. If he exit here, he's going to sell below a bear bar, either below that bear bar or that bear bar. And the same here, if the bear exits above that bull bar and the market does not become always in long, it's still always in short, he has to sell again below a bear bar, like below that bear bar or below that bull low. A good trader is not going to let himself be trapped out of a trade for long. If the market is still always in short and he exits and he wants to trade always in, he wants to stay in the market all the time, he has to sell again below a bear bar. And the opposite is true in a bull trend. In a trading range, the probability is high for the bears near the top and high for the bulls near the bottom. The market is clearly going sideways here, and at some point you decide this is the upper half of the range, this is the lower half of the range. In general, you want to buy low, sell high, and scalp. If it's in the top half, it's better to look to sell. If it's in the bottom half, it's better to look to buy. And it's also better to look to take quick profits, scalp, because chances are the market's going to stay in the range. The probability for making money is higher in the upper half if you're a bear looking to sell. And the probability for profits is better for the bulls in the lower half. Buy low, sell high. Bears make money selling in the upper half, bulls make money buying in the lower half. In the top third, the probability can be very high for the bears. For example, if you're looking to make X number of ticks or pips, there's usually a 60% chance that you'll get your target before your stop is hit if the stop is just as far. So 10 ticks or 10 pips, looking to sell in the upper third, 60% chance you'll reach your 10 or pips or 10 ticks profit before a 10 ticks or 10 pip stop is hit. Doesn't matter, 10 ticks, 15 ticks, 27 ticks, 27 pips up, 27 pips down. In the upper third of a trading range, taking the bear side has a 60% chance of making money. On the lower third of the trading range, taking the bull side has a 60% chance of making money. For example, buying in the bottom third, looking for a 10 pip scalp and risking 10 pips, 60% chance you're going to make money. The middle third, it's 50-50 chance that buying or selling, that you'll make X number of pips or X number of ticks before you lose the same amount. So for example, buying or selling anywhere in the blue, in the middle third of a trading range, and you're looking to make 10 ticks or 10 pips buying, risking 10 ticks or 10 pips below, you have a 50-50 chance that the market will reach your target before it hits your stop. I talked about high probability and how every trader is 90% certain of making money, at least briefly during every trade. When the market hits their limit order and they need only one more tick or one more pip to make money, their stop might be 10 ticks or 10 pips away. They can only hold on to that trade if they are 90% certain that they'll make money, and most traders would hold at least after the first test of their target. The 40-60 rule, during 90% of the bars on every chart, the probability is always at least 40% for any buy or any sell, and it's never greater than 60% for any buy or sell. A good trader can make money buying or selling during 90% of the bars on a chart if he manages his trade correctly. When the market's in a trading range, the probability is high near the top for the bears and high near the bottom for the bulls. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fifth of 5 videos on the trader's equation and probability.